Hello and welcome to Moneycontrol. I'm your host Nikki Manchandani, and today we are going to be talking about one of the leading player in the consumer electric product industry, who's set to kick off subscription for the initial public offering on September 13. TPG backed company is looking to raise around 1,964 crores through this IPO, which is divided into two parts: fresh issue of 180 crore and an offer for sale of around 1,784 crore. The price band of this issue is fixed in the range of 983 to 1,035. But to talk more about the company's business model, strategy and the financials, we're being joined by the management of the company, Shreegopal Kabra, who is the managing director, and Rajesh Jain, who is the chief financial officer of the company. All right, afternoon gentlemen, thank you so much for joining us here. Straight up, first I'd want to understand from you, discuss more about your business model. Does the company generate highest revenue, almost 74%, from the business consumer sales, that is the B2C sales channel in wires and cable? How does that model differ from that of the other FMEG players? Could you explain that more in detail?
Yes, so basically from inception we had a purpose and vision of RR Kabel that we would like to create a brand not only in just India but globally.
Right.
So that's why our entire focus was into retail, whether it's an export business or domestic. So we have focused, we have become first marketing driven company in India, beginning, look into from keeping my name of RR Kabel. So generally it has to be cable in India.
Right.
So but then before this we didn't have any background of the business, we had nothing electrical business. We thought let's go something different. So we did it, and then we became the first company in India to have the 35 international approval for single factory, international approval. It's the biggest thing achievement. We are 100% REACH compliance, ROHS compliance, and we became one of the fastest growing company, and focus is that we move from wire to cable and cable to FMEG. So in terms of our revenue, last year was 5650 crores.
Right.
After this, wire and cable was 4950 crore approximately. So after this, 74 is B2C retail.
Right.
Because we believe that we want to create a brand. So for us, this electrical business itself, the safety is the biggest concern. So
Right.
we became the first company in India or Asia to make low smoke, zero hazard wire. See, when you read in the media, you see that this meant how many people died in fire, but generally people die because of smoke. But headline has become always like people die because of fire.
Correct.
So it's a smoke-free wire. So that's kind of safety we're making. So we are there this business since 1999, and today our market share in retail. That's why we became marketing driven. So market share retail is very much focused. Retail is hard to us basically, and people are giving a lot of respect for us, our product, and we became in 23 years. This is a very young company to the peers, and then we are there almost all over, not only India but then globally. We export to 63 countries, and our entire export is to for distributor and distributor supplying to retail. So in 92, see, we need to understand how many companies in India, not only just in our sector, who created a brand globally. So like RR Kabel, we are in 63 countries. Like that, how many companies, not only just wire and cables category or FMEG category or in any category altogether. So this is proud for us as an individual company and proud for the nation.
So rest of the, just to understand a little bit more about your business model, which is B2C. For other players, they're not into B2C, they are into B2B, is it?
Yeah, because they are into both B2B, B2C, everyone is there. It's a percentage difference there. So like that, we are there 74 to 75% B2C. PS might be 30% B2C, 70% B2B. Because their reason is also there, because they came from cable to wire and then separate. We came from wire, and our focus was from beginning, from inception of the company, that we would like to more to retail focus. Then of course the projects, we are there and we may gradually move.
The reason why I'm asking this question is just to understand about the margin profile, perhaps, because if you look at the margin profile as that compared to Havells or Polycab, KEI Industries, the margins seem to be a little on the lower side. A 6.35% compares to that of 10%, 7%, the range is 8 to 10% for the industry. Why is that a little bit of differential within the EBITDA margins of the company?
I'll tell you, because the reason behind it, we need to understand our out of our business, 25% export. So in exports, my efforts in terms of like kind of efforts I do in marketing here, kind of ASP spend I do, kind of I take a risk in terms of initial stage to take manpower, creating demand. So that also cost is very high. So my 25% exports, where my margins are lesser than the domestic market, because there my business are into bulk, I get forecasts in 3 months advance, 2 months advance, and a lot of advantage we have. So it's because of export and domestic mix, our margins are little low. Number two, our ASP spend, since we want to grow fastest, we to acquire the market share in the market business, right? New company. So my ASP spend is also almost double than my peers.
All right. I wanted to understand, since you spoke about your, first I wanted to check with revenue potential, but since you have spoken about your domestic volumes first, so for domestic market, you are considering, it's a fifth market share from India that we have for the exports. So for exports, it's more of a volume game rather than a margin game because it's probably more value accretive margins in domestic market as compared to export markets?
It's a volume and margin, both games.
But you just said, given the margin profile, you gave me an explanation.
But we need to understand that when we started this export, we started in 2001. In 2001, neither RR has a credibility in the market, neither as a country, India has a credibility.
Right.
Now, we are quite fortunate that as a country also, India created brand, and as a RR Kabel also, a lot of hard working we created brand. So now our margins are increasing, number one. Number two, initially we had only just 3 products of wire only category. Then we moved to cable, and then when you want to export, you need to have a lot of international certificates. It's a period is there, journey is there. Now we shifted from wire with wire. Now we are starting exporting of cable because see, I have that market presence was there. So from market now I get a high margin business. I am getting started. So it's a beginning. Now in 23 years we establish our business slowly. Then now what kind of business mix we have now? My exports margin is also increasing, and it will increase further.
Okay.
Yeah.
Okay, so that explains perhaps the reason why the margins have been lower as compared to the peers, because of your focus incrementally on the exports market, which until now was volume driven. But you expect now that to be a margin driven game.
Yeah, well, also in domestic I have one disadvantage because my cable size is very small. So what happened, my distributor, when they want some material, I give them 30 days, 25 days. So I don't get a price positioning there in cable. Otherwise, other peers, they are very strong in cable. So our stocks are well. Sometimes our distributors, they have to sell at a lower price because of delivery issues are there. So, and because of that, my revenues also I am losing.
Okay.
Since now my cable expansion will happen, then I will get an advantage both. So because after that, when I have cable in sufficient quantity and wire we have all together, if I have mix, then my margins will also increase even in domestic also. That these 2-3 things are there together. Yeah.
Okay, so I wanted to understand from you, how is the mix going to change for the company overall within India and outside India? The share, since you are focusing more on the export markets, and also in terms of your segmental breakup, is the mix going to change anytime soon? Because we have seen, FMEG business revenue being a little more, the contribution from that segment perhaps picking up a little more. Do you expect the revenue mix to change more?
Yeah, revenue mix will change into both. Wire and cable itself will change because see, generally if you look into wire and cable as a business, 70% is cable, 30% wire. And our ratio is other way around. So we are now 70% wire, 30% cable. So this will go to almost, say, for example, 60% wire, 40% cable. Okay. Exports will remain 25%. It may go up 1%, 1% up, and 2-3%. So our focus is mainly domestic. But export was why we went to export? Because we wanted to have avoid this factor. Because of export, I tell you, in COVID period. So we became the only company in India who maintained the volume. Even though in spite of this, India was closed for almost 4 months. But we could manage that, number one. Number two, because of this export business, we have developed so much quality. Today, if you look into quality, kind of quality we make, kind of range I have, so as per global standard. So that's an advantage. So indirectly we have advantage because of that. Since we export to now foreign companies, now many foreign companies are coming in India today. So for them we will become first priority.
Right.
So it's a long-term vision for horizon. So it's a both advantage we had because of past we did a lot of efforts for exports. We could have developed the quality. See, to have a 35 international approval, and it's a lot of effort. We have to be very cautious, careful. They don't inform when they are coming. So we have to give a calendar at the end of December. This whole year we got this as a holiday. So they come without information. So we are always alert.
Since you spoke about the change of the segmental breakup, a bit about focusing on the perhaps maintaining the strategy of focusing in the domestic market more than the exports market, on steady state basis, what is the margin profile you're now targeting? Do you think that is going to change as compared to your peers? 6.5% can become 10-12%? If yes, by what year?
No, 10, 12 we don't say. We say it will be around 9.5, 9.75, 11.
Please
So
go ahead.
see, we cannot make any forward-looking statement, but
Sure.
when we see when what Shreegopal ji was explaining, when we see in past we have invested very heavily in expanding our base of electrician, base of retailer.
Right.
If we see last 2 years, we have spent like almost double of the industry average in advertising and sales promotion. Like we are the only company who have more than 2,98,000 registered electrician, which is biggest in the industry as per our knowledge.
Right. That's,
So in
that doesn't answer my
So
question,
that's
right?
no, I'm coming to that only. Ki, like the way we have invested in growing our business, so we have created a very good base, and this is right time where we can expand our expand our profitability, expand our growth. So that way we have made very good base for the growth of the company.
So 9.5% is scalable by when?
So that we can comment, because we have some guidelines.
But you almost
so we
said
cannot-
it's not something
Yeah,
which
so
I'm asking for FY24. I'm just saying
Yeah, so of
you
course
think
we
you're
are on the way.
scalable to
So-
9.5%.
So we
could
are
be
on that
5
way.
years, could be
Yeah,
3
yeah.
years
So we
for
are
that
on
matter.
so we are on that way of growth to scale our business in terms of revenue as well as profitability.
Okay, so 9.5% is what the aim is, and the
Sure.
period is something that we're not looking at right
Sure,
now. Have
sure.
I got that
Yeah,
right?
Yeah, absolutely.
Okay. So let's talk about your peak rate revenue potential. CAGR of almost 14 to 15% in the last 3 to 4 years, from 20 to 23 onwards. We've seen that CAGR growth in terms of the top line. The company is now the 5th largest player in the wires and cable market in India as per the RHP. A, how much more share do you intend to capture? And B, what is the highest potential rate, peak potential rate for your turnover?
So first, the good thing in last 2 years, our revenue CAGR is 43% in domestic, 47% in export, and 53% in FMEG. So altogether, we have grown at the rate of 45%, much ahead of the industry average. And at the same time, when we see the industry in which we are operating, like wire and cable and FMEG, good thing India has a big potential. We are growing very big in infrastructure, in residential. Like now, industry is moving from fossil fuel to green energy. Same way from traditional vehicle to e-vehicle. So this industry as a whole has a great potential to increase, and we are on the right path in the right industry at right timing with right product profiles.
So the CAGR growth of 45% is from what period?
21 to 23.
21 to
previous
23.
2 years.
Okay, all right. So perhaps 20 was a bit of aberration, but do you intend to replicate the same growth?
So in this, since prices are determined by the raw material prices, because copper and PVC, how it will aluminum. But if we talk about
But
in volume,
that's more of the operational performance,
that's
right? I'm
why-
just talking in
so-
terms of the revenue front.
So that's what I am telling you. In volume terms, we are quite sure that we are growing at much ahead of the industry average, and we intend to replicate.
45% growth is replicable over the next
Yeah.
similar years that we're looking
Yeah,
at.
it is possible. Yeah, looking to industry growth and everything.
Okay. So that's one. I wanted to understand a couple of other things actually. The growth in FMEG business perhaps has been largely driven by acquisitions, if I'm not wrong. Correct me here.
Yeah.
Any amount do you think has been further earmarked further for the inorganic expansion? At what rate do you expect the growth to come in just organically?
See, organic growth, if you take on the past record, so we are growing in FMEG 40% CAGR without acquisition. For acquisition, we got a separate growth. So we would like to maintain that growth for even future. That's our plan altogether, right?
Right.
And kind of these 2 acquisition we did, and then we also got in-house manufacturing. So at present, we don't have any plan for any more acquisition. First, we would like to stabilize what we acquire,
Right.
then move. Yeah.
Fair enough. So let's talk about your significant investor, TPG Asia, significant shareholder of the company. How much does the stake come down to? The weighted average cost is roughly around 270, and the price band is to an extent of 1,000, which implies multifold jump for your investor. What has driven the company from FY18 to FY23 to this price levels? What are the driving factors? And what do you think will drive the next leg of earnings or the turnover profile that you guys have projected? Which will be those factors that will take the company ahead?
So, like if we see the growth of our in last 4-5 years, the first our base is very strong in terms of quality, in terms of like the quality what we are offering to our consumer. because in this industry, wire and cable, when it comes, safety is the most the factor which should be the decision making process. And we are the only company who is giving 100% ROHS and REACH compliant product, though it is not necessary in India, but still in the interest of consumer, still for environment, we are doing this. So with such a strong background of quality, such a strong background of product innovations, we have arrived to this number. Very interestingly, like from 0 to number 5 in such a short period of 23 years. So we have very strong fundamentals in for our R&D capabilities, for new products, for growth in new geography, new products. So by that way is the base of our company, which we think we can replicate in the future also.
All right, and talk about TPG Asia's shareholding pre and post issue. What is the mandate? What is the lock-in period after 6 months? How much can they sell?
Sure.
Provide us with more detail, please.
So like TPG invested 21% in our company in September 2018, and in this issue they are just have OFS for almost 11% of the shares, and just before this IPO they have done pre-IPO also for 4.4%. So after this their holding will be around 6%. After listing, they will have a lock-in period of 6 months.
Okay.
Yeah.
Okay. All right. So that's pretty much a multi-bagger gain coming in for the company.
Yeah.
But let's talk about the objective of the proceeds, right? How do you intend to use? See, most of your proceeds, the IPO is mainly driven by OFS.
Yes.
And less part of it is earmarked for fresh issue. So the one that is earmarked for fresh issue, talk us about the proceeds, how you're going to be utilizing it, what would that mean for your company, how would the utilization level pick up with that?
Yes.
Your details, please.
So in this IPO, we are coming with the 180 crores of fresh issue, out of which like almost 136 crore we will use to repay our debts and working capital and term loan facility. Rest will be used for general corporate purpose. And like since we are having sufficient working capital arrangements and we have our own grant plant which can be meet with our internal cash accruals itself.
All right, gentlemen, we'll leave it at that. Thank you so much for taking out the time and speaking to us.
Thank you.
Thank
Thank
you.
you very much.
All right, with this, it's a wrap. Thank you so much for tuning in.